You just inherited an IRA from someone and you may be having a lot of questions. What we want to cover in our video today is what you need to know about what you just got and how best to handle it. Hello, my name is John Vandergriff. I'm one of the owners and the wealth planning team lead here at Blue Ridge Wealth Planners, where we help people answer questions about everything that has to do with your money in retirement, but also money that you inherit from people that may have already been retired. And so we're going to look at that today because with some recent rule changes in Washington having to do with the Secure Act, it does change the way that you inherit money and what you need to know about the decisions that you have to make. So specific to IRAs, this is going to be different than really any other type of money that you inherit, because if you inherit a home or after-tax investments, a lot of times you'll get a stepped-up cost basis to the date of death value of those assets, and so you may not even have a taxable event if you immediately sell those. IRAs will be different, and the first thing that we have to look at is that first, all of this money will be taxable. So everything that goes into an IRA is tax deferred, and if the owner didn't pay the tax on it, then whoever the beneficiary is will pay those taxes. But the big question is, when? When will you have to pay those taxes? Well, you have some options, whether you've been told that or not, when you inherit an IRA, and so we want to look at those when we're answering this question of when. And so the first one is you could pay all of those taxes in a lump sum. If you didn't want to deal with any of the complexity, you could just inherit whatever your IRA portion is. That will go on top of your income taxes that year. Those income taxes will be settled once you file your taxes that year, and then you'll not have after-tax money. You will no longer have an IRA. So that's one option. The other two options have to do with repositioning this money in a special type of account called an inherited IRA. So what that does is that allows you to avoid a lump sum tax obligation with this money and take advantage of either option 2 or 3 here, which is the way the rules are now based on the Secure Act is that you have 10 years based on the year after the owner's death to liquidate this account and pay those taxes. So you could either wait until the 10th year, or you could take out however much you want to in between that first initial year that you have it and then 10 years after the original owner of that account's death. So as we look at that, you say, okay, well, I've got 10 years. I can just deal with this problem later. I can take out some. That's not totally true, because what gets a little bit complicated has to do with the fact of if the original person that you inherit this account from was taking required minimum distributions, or as we will often refer to it as RMDs. And so as we look at that, that matters because that will tell you whether you are forced to take some money out every year or not. So as we look at this, if the original owner was taking RMDs as of the date of their death, you must take out at minimum a percentage that's based on your age out of that account starting the year after the original owner's death. So not the year they die, but the year after, you will have a certain percentage that you will have to take out. So the natural question becomes, what percentage do I have to take? How is that calculated? Well, like original RMDs, this will be based on the December 31st value of the previous year divided by the age component. But for inherited IRAs, it will have a different type of structure than RMDs that are associated with people in retirement. Those normally don't start until 73. As you see here, depending on when you inherit an IRA, this table will technically go all the way from 0 to 111. We've cherry-picked what would be more common ages for anybody that's watching this video, but if your age isn't up here, we'll be happy to talk to you about that whenever we have a conversation. So you'll have to take this life expectancy figure, divide it into the total. It will give you roughly this percentage that you see in the middle column here. So here's your life expectancy. This is your percentage of the account for those of you participating at home. So this tells you the minimum amount that you have to take out during those 10 years. The reality though is if you just take the minimum out, you're still going to have a lump of money that's left at year 10 that you're going to have to deal with from a tax perspective. So as we look at this, we have to look at this and say, okay, this is what it means for people that have a beneficiary who was over 73, and if they had RMDs, usually whoever you is handling the estate will tell you that, or at least the custodian of the original IRA will. If the person doesn't have RMDs, you can defer or take freely until the 10-year mark. So you could, let's say you're in a situation where you're 60 years old, you're looking to retire in 2 years, you could technically defer taking anything out of it for 2 years, wait until your income drops and then start taking distributions out, or you could wait until the full 10 years is up. Either way, the stipulation that we have to pay attention to is if you're in the position, and that's a very ugly star, so the entire account in either case must be liquidated at that 10-year mark post the original owner's death. So as we look at this, you're going to be in a position where, depending on how you take it, will determine if that's more of an even spread, if you defer it till later, or if you take it over 5 years. You could still take it in year 2 as a lump sum. You get a lot more flexibility if the original owner is not taking out RMDs. So the natural questions that come from looking at this are, first, how should I take out from this inherited IRA? Because even if the original owner is requiring you to take RMDs out, you may benefit from taking that percentage and then some if you're trying to have a more even split, because just simple math says if it's a 10-year distribution that you've got to take, starting out with approximately 10% of the account balance, maybe increasing that a little bit as that account grows, could be beneficial to you so that you don't have a lump sum tax burden either at the beginning or at year 10, like we talked about in our first slide here. But then the second question becomes, how should I invest this money, especially knowing that we will have to take out some distributions and we really only have a 10-year time window to invest in this particular type of account. So like we have with every investment conversation, you really have to divide up the money in between the types of objectives that you're trying to hit. If you're a younger person, you may want this to be more growth oriented, but I would caution you to have some amount of this that's in a protected state so that you at least are taking out or shielding whatever you're forced to take out from the inherited IRA if you are in that RMD scenario. Again, trying to prioritize your investments based on who you are as an individual, but also the needs that you have from this is very important. And if you're in a position where you need to withdraw this entire bucket over 10 years, that should impact the types of investments that you use depending on the type of category that we're looking at. So as we look at this, it makes sense to include this discussion in your entire picture. So yes, inherited money rarely is planned on. You may not have even known what the amount was, but if you're in that position where you just inherited an account, I would encourage you to go through a discussion very much like the one we do first time that we talk to somebody, understanding what are the goals and objectives that we have, not just for the inherited IRA, but for your money as a whole, and then how do we need to plan for income distributions, investment philosophies and risk, tax planning, healthcare, and family legacy when it comes to these inherited accounts plus the other accounts that you have. This needs to be included in the discussion once these dollars are actually in your name and become a part of your financial picture. So as we look at this, if nobody's walked you through this yet and you've just inherited some money, I would encourage you to have a discussion like this. If you don't know where to go, we'd be happy to have that discussion with you. If you look at the link that's below this video, you can click that, schedule a time to talk to us here at Blue Ridge Wealth Planners. We can walk you through this scenario, help you understand everything that you're facing, and really see what's the best path for you as an individual. Because I firmly believe a cookie cutter approach to this is not what we're after. We need to make sure that the advice that you're getting is specific to your situation. And that's something that we handle and do on a daily basis for our clients, for people that are facing a retirement decision, and for people that are inheriting money and not really sure what to do with it. So if you have any questions about this video or maybe some of the terms and things that we've discussed, please leave a comment below. Make sure you subscribe to our channel so that you can get more information like what we've covered today. And again, when you're ready, if you want to click that link and schedule a time to talk to us, we'd be happy to walk you through really any questions that you have or look at your situation as a whole. Thanks for joining us today. Hopefully this information was helpful to you, and we look forward to sharing more information like this with you in the future.